Good afternoon and welcome this afternoon to Selecting an Option Strategy, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my friend Cameron May, great educator and 20-plus year veteran of the financial markets. He's going to be there to help answer your questions along the way. Here we are on Thanksgiving Eve, and we're going to go ahead and jump on into this discussion. And we're going to answer the question that comes up in this particular class quite often, obviously, but also in a variety of other locations as to how do you choose one particular strategy or another. So I'm going to talk a little bit about trading or making that decision in 3D or 3Ds. And we'll see what that means here in just a second. So as we get started, a couple quick housekeeping items. Remember, everything we talk about simply for illustrative and educational purposes only. Not a recommendation, shouldn't be considered any kind of an endorsement of strategy or pattern or security. Also, remember that options carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. Remember that multiple leg option strategies will involve multiple commissions and transaction costs. Also remember that spread trading must be done in a margin account. Lots of different ways to look at the market: probability, fundamental analysis, technical analysis. All of those are theoretical. None of those are guarantees as to what the market is going to do. And remember that because of that, Schwab doesn't recommend the use of technical analysis or any other method as a sole means of investment research. We're going to be using the Thinkorswim desktop software platform today. It is a great learning environment. It is not a guarantee of future success. The paper money version that we're going to be looking at, again, it gives you an opportunity to practice, but it doesn't do certain things. It does not facilitate the early assignment of short options. Because remember, anytime you're short an option, if it's an American style option, you can be assigned prior to expiration. Now, also remember that when we talk about these ideas, that there is risk involved in trading in trading options, so be aware of that. Remember that when if we talk about stops and things like that, those are not guarantees as to the execution price. You can specify the activation price, but not the execution price. And in the case of a stop limit order, that is, there's the possibility that the price of the stock can gap around the limit order. Now, so that being the case, as we start to talk about these strategies and get into these discussions, we're going to be answering a couple of different questions. The process that we're going to go through is pretty straightforward. Right? We're going to talk about the market conditions. We're going to discuss which market or which option strategies might benefit from the current circumstances. So this is kind of a, if you will, a real world example, taking a look at what's going on in the market at the moment. We'll put together some illustrative example trades based around these ideas of what the market is doing. So let's kind of really quickly just review what some of those strategies might be. If our first discussion is perhaps bullish, bearish, or neutral, we can kind of break down strategies into those three kind of subgroups first and foremost, right? Bullish, bearish, and neutral. That's going to be kind of the first approach or the first thought process in this scenario. So remember I said we're going to look at things in 3D. We're going to look at option strategies in 3D. So my 3Ds start with direction. D, direction. So we're going to choose a direction. And then the second D is going to be duration. The third D is going to be demand. And you'll see what I mean by that. So let's do this. Let's pop out to the Thinkorswim desktop software platform. And while I do that, it's a good opportunity for me to ask you to click on the subscribe button down there at the bottom of the page. That is the way that you get connected to the Trader Talks webcasts community, if you will. And it's a great subscription because it is at no cost to you. Click on that subscribe button down there at the bottom of the page. So let's take a look at the first D here, direction. And I have those kind of listed over here on the left-hand side: direction, duration, and demand. We'll take a look at the first D, that is direction. So what direction is the market moving? Overall, longer term, the market is moving in an upward direction. We could use the 200 period moving average as an indication of that. We could use a shorter moving average. We could use a 50-period moving average as an indication of that. We could use highs and lows. And we see that market, in this case, the SPX, kind of moving higher over time. So intermediate to long-term time frame, definitely the market is moving in an upward direction. Short, however, short time frame, the market's kind of moving sideways. It's kind of banging its head on this resistance level again. We see a little bit of a downward push in this one candle right now. We see that little bit of a push to the downside, and that possibility of maybe bouncing down towards this level of support. So the possibility of maybe making a double top here, kind of getting into that scenario where maybe the short-term movement is neutral to down. So that may lead us to the next kind of D question, which is duration. If we were looking at something like this, where price was running up into a resistance level, if our duration, right, that's our next D, if our duration was short term, meaning days to weeks, we might be looking at a downward direction or a neutral direction. So short term, we might be bearish to neutral. Intermediate term to long term, we might be neutral to bullish. So that's really kind of the next deciding factor, right, is that duration. And then the third D overall, which we're going to answer this question for each individual position, but also for the market as a whole. The next D is demand, right? What is demand? Now, I'm going to throw that question out to you in this discussion. What might we be talking about when we talk about demand in terms of options? When we talk about demand, what is it that we're looking at, right? So let's do this. I'm going to shift my grid over here to a different grid, and we'll see if that's maybe helpful. And we'll come back over here, and I'm going to pull up a grid that I use on a fairly regular basis. By the way, there is speaking of demand, there is demand for a feedback survey out there in the chat. And that feedback survey is how we make these sessions better. So do me a favor, take just a couple of seconds, fill that out, or fill it out by the end of the discussion, and that's going to be helpful. So Joe says vol. So volume could be an indication of demand. I'm going to go in a slightly different direction with the answer to that question. Not necessarily open interest in volume, but what I'm going to look at is volatility, because volatility really is, at least implied volatility, an expression of supply and demand, right? There's that D question. So I'm going to look at the VIX. We're going to look at the volatility index for the market. And this one is the one that I'm going to look at. Here's VIX. VIX is the volatility index for the market. What that says is, in general terms, when the market has an expectation of movement, there is generally greater demand for options. Options become more expensive, just like other products, when there's more demand for them. So the VIX is a measurement of how expensive those options are generally. So what we're seeing here in this particular case is that options are becoming more expensive when the VIX is rising, less expensive when the VIX is falling. Therefore, more demand for options when the VIX is high, lower demand for options when the VIX is low. And that's just kind of the scenario here. Now, if we were going to answer this question, so we've answered two of the questions about the market so far. We said, all right, here's the SPX. It is long-term bullish, intermediate term, maybe bullish to neutral, short-term, neutral to bearish. So that's the first D, right? Direction. Second D would be that duration. We kind of have to decide which of those durations we're going to choose. And then the third D is demand. Demand is relatively low and rising. We see the VIX down around that 13 level with the possibility of it bouncing and moving higher here. We see it ticking up just a little bit today when we see that possibility of a move higher. VIX tends to be mean reverting, so when it gets low, it tends to rise. When VIX is low, it tends to rise. When VIX is high, it tends to fall, and it sometimes falls very quickly. So volatility generally is low and rising. Direction is bullish to neutral or neutral to bearish. Time frame, it's 6 to 5 and pick 'em. You get to pick your choice here in this particular case. So you know what I'm going to do is I'm going to take the approach of, since I'm going to kind of take a shorter duration, right? Shorter duration. I'm going to take the approach of saying, let's take a look at a stock that is perhaps bearish or neutral to bearish, maybe neutral to bullish, or maybe just neutral, and benefits from low implied volatility and rising. So let's take a look at an example here. Now, there are a lot of different ways to do that. I happen to have a watch list that's titled low implied volatility. So I want to kind of match my selection to what the VIX is doing. VIX is low and potentially rising. So I want to look for stocks that have low implied volatility and the potential to rise. And the one that I found here is Delta Airlines. Delta has an implied volatility percentile of about the 44th percentile. Means not terribly low, but it is lower than it has been over the course of the last 52 weeks, right? So over the course of the last year, that implied volatility is lower than the midpoint. So low typically tends to rise. So we're going to take Delta as our example here. I'm going to shift my grid over to my single grid, and we're going to take a look at Delta, D-A-L. And one of the things that I happen to notice is that Delta directionally has been moving solidly to the upside, but it has kind of paused. So that's very consistent with what we were seeing in kind of that short-term time frame on the SPX. Short-term, neutral to bearish or neutral to bullish, or neutral in this particular case. So if I'm looking for neutral movement and I've got implied volatility that is low and rising, so let's put the implied volatility study on here, IMP, implied volatility low and rising. Let's put that study on here. That kind of looks like what the VIX was doing. It was low and now rising. Plus, we've got an earnings announcement over the horizon here on the 10th of January. We could probably argue that implied volatility is likely to go up, right? Likely to go up. Okay, so Thea asks a great question. Can we please explain how it will help by selecting implied volatility low and rising, right? Because if we're long an option, low and rising implied volatility is going to be a benefit for us, right? Because that implied volatility is going to make that option more expensive, right? If we were going just short an option, then low and rising implied volatility is going to be working against us. High implied volatility and falling is going to work against long options, but that's going to work for short options. So in this particular case, we're going to take advantage, or we're going to look at a strategy that might benefit from neutral price movement, meaning the price just kind of staying in a fairly neutral range, and implied volatility low with the potential to rise. So let's think about that. Now, a long call option, if we were to choose a long call option, that long call option requires directional movement, right? So let's kind of put these D's in here. So our direction is neutral. Neutral direction. Duration, short, and demand is low and rising. Demand is low and rising, okay? So that is the potential here. So as we kind of sit at this point right here, this is where we are kind of getting to this perspective in terms of choosing a strategy. So let's think about this for a second. If we were to come over here to the trade tab for Delta, okay, and we were going to look at a short period of time, in this particular case, maybe let's go out 30 days to go to a long call, right? So a 30-day long call, if we're looking for neutral movement, well, the problem is if the price of the stock doesn't move, then we're being overwhelmed by theta, even though implied volatility might rise, right? Because theta is going to increase as we get closer to expiration. Vega is going to decrease. So volatility sensitivity is going to come off, but theta sensitivity is going to increase. So we got to have directional movement. We don't have directional movement, so we can't choose a long call option here in this particular case. Same thing with a long put, because the price of the stock isn't likely to move down either significantly enough to offset that time decay, right? The theta decay. Also implied volatility sensitive, but it's not going to offset the time decay here. So we're not going to choose a long put in this particular case. So what we've got then to deal with is the potential that the price of the stock stays the same, changes in implied volatility, and the passage of time. So what we're going to do is we're actually going to come up with a strategy here that combines a little bit of the two of those scenarios here, but doesn't necessarily require directional price movement, right? Relatively neutral. In fact, we're kind of directionally agnostic here in this particular case. So what we're going to do is we're going to take advantage of a dispersion between, or a difference between, implied volatilities so that we can take advantage of that effect on our individual legs. We're going to come up with a strategy that benefits from the passage of time and a rise in implied volatility. So let's look at this strategy here. Let's choose perhaps a calendar spread. So what we're going to do is we're going to go out to the December 27th, that 30 days to go until expiration. And that has an implied volatility level right now of about 36%. And then if we go to remember that 44th percentile is putting implied volatility in context. Then we're going to go to an option that expires on the 13th of December, because that has an implied volatility of about 38%. So here's what we're going to do. We're going to buy the one that has the lower implied volatility. We're going to sell the one that has the higher implied volatility, and expect that implied volatility isn't going to necessarily spike, but it's going to generally rise relatively slowly into that earnings announcement. So what we're going to do is we're going to go to the 27D expiration, and we're going to find the at the money strike. Okay. Now we can do this with calls or puts. It doesn't matter, right? We can do this with calls or puts. It really doesn't matter. Price of the stocks right now is 63.77. So I'm going to go to the 64 call option. We could do the same thing here with the 64 put, but I'm going to use calls in this particular case because if it does continue to move in that trend, we've got a little bit of directional sensitivity to it. So I'm going to buy the 64 strike call option in this particular case. We're going to buy that 64 strike call, and then we're going to go to the option that expires in 16 days. That's the 13 December expiration. And we're going to sell the 64 call at the same strike price, right? Same exact strike price, just different expiration. Now we're creating a calendar spread that takes advantage of that disparity between implied volatilities, between expirations. It costs 70 cents to get into the trade. And if we confirm and send and we see what our maximum gain is, we can't see it here, but here's what we're going to do. We're going to go back and we're going to right click and we're going to say, analyze the trade, right? And we're going to put this back on DAL, and we're going to hide positions. We're just going to look at our simulations. So here's the trade, right? Here's this particular example. And this is the long call calendar on Delta centered on the 64 strike, right? That 64 strike is where we'd see max theoretical gain in this particular case. Relatively low cost to enter, and all we're expecting that the stock is going to do is simply sit there right about the 64 strike. If it goes up a little bit, if it goes down a little bit, that's okay too. We're going to set our slices to break even here. So we make money make a little bit of money potentially if the price of the stock stays between 61.30 and 67.16. I'm going to cross-check those levels to the chart. So what I'm going to do is come over here to the left-hand side, and we're going to set those slices to our chart really quickly. And there they are. Here's our slices, 61 and 67. So we're expecting that the price of the stock is kind of going to stay in that area that we were seeing it bouncing around in. Ideally, we want to see it kind of stay right around that 64 level. So that's kind of where we want this price to stay. We want implied volatility to go up because that's going to benefit our long option. So here's the thing. As we put this trade together, what we're going to do, if we go back to our Analyze tab, we're looking for a range here. Now, here's the problem with a calendar spread, or one of the challenges with a calendar spread, is that we essentially have a fairly small target, right? We want to see the price of the stock stay right at that point. What we can do in putting this trade on is not look for necessarily maximum theoretical gain, but look for a gain somewhere in a wider range of expectations. So we're going to kind of make this a little bit wider. We're going to make this a little bit more like a long iron condor, for instance, but we're doing it with 2 legs instead of 4 legs. And so because of that, we're going to try to take this trade off, not when it gets to that absolute maximum gain, but we're going to take this trade off when it has given us a portion of, or some portion of, that potential maximum gain that it can make for us, right? So what we're going to do is we're going to look at taking this trade off. If we put our cursor on that 64 strike, we see that our maximum gain is $103.67. Might very well be. Some of you might find better success than others in that particular case. So let's do this. Let's take a look at another example. Let's come over here to the charts. And if we've got low implied volatility and we've got directional movement, let's see if we've got something that's got low implied volatility but isn't necessarily quite as sideways as Delta Airlines. So we're going to go back to our Market Watch tab. We're going to look at our low implied volatility percentile watch list. I'm going to sort this list based on implied volatility percentile. So what I'm going to look at is something that is perhaps moving based on low implied volatility and maybe starting to see a little bit of a breakout here. Did I do the math wrong, Chris? If I think I may have put an extra decimal in there or moved the decimal 2 places instead of 1 place. So if that's the case, we'll just change that, right? We'll change that order. Thanks for catching that, Chris. I thought it might be incorrect. Anyway, so we're taking a look at Apple here really quickly for maybe a more directional move. Let's see if it's moving in a more directional fashion. So we're going to go back to our chart and we're going to take a look at Apple. So here's Apple, implied volatility relatively low. Apple kind of making that move to the upside. It's perhaps pausing a little bit, but we might be looking for perhaps a little bit more of a directional move on the stock, right? Maybe breaking out of that previous resistance level here. So if we are let's answer our 3Ds question here, right? So if our direction is bullish and our duration would be, in this particular case, maybe intermediate to long, and our demand is low and rising, if we see that breakout above that resistance level, then what we might do is put together a trade that benefits from low and rising implied volatility, is bullish, and there's a couple of different ways that we can do that in terms of choosing strategies. So let's go to the trade tab again here for Apple. And let's drop this order position down. We'll close that up and we'll take a look. So if our duration is a little bit longer, right? Direction is bullish, so we're probably in this particular case going to be using calls or short puts. But if our implied volatility is low, that doesn't benefit selling short puts or cash secured puts. So we want to use calls perhaps in this particular case. So what we're going to do is we're going to either do a long call or we're going to do a long call vertical spread to take advantage of that bullish direction. So we're going to go out in time a little bit here. We're going to go out about 44 days to go until expiration. So here's kind of, again, the decision-making factor, right? One of the things that we might choose in terms of making those decisions. If we were going to go to a long call, that's going to have the greater amount of delta sensitivity, directional sensitivity, right? So we're going to look for an option that has a fair amount of sensitivity directionally, right? In this particular case, maybe one that's in the money. Now, that's got a relatively wide bid-ask spread. It's not terrible, but we might look for a tighter bid-ask spread. But theta is going to work against us on a daily basis to the tune of about 8 cents. But this has a much higher sensitivity to implied volatility changes. So if we get a rise in implied volatility fairly soon, that's going to be beneficial to this long call. So we could choose this long call. I'm going to do that. I'm going to put this trade on, and then at the same time, we will do that long call vertical spread to compare this as well. So we're going to go to the 225 strike, and I'm just going to look at buying this 225 call, right? So in this particular case, if we click on confirm and send, infinite maximum gain, the cost on the trade is going to be about $1,400, right? So that's one potential choice here that we could use, buying that long call option and expecting that the price of the stock is going to go up and it's going to break out. So very directionally sensitive, time sensitive for sure, but implied volatility sensitive, probably the second biggest influence here. So we've answered kind of those directional, those 3D questions here. So we'll fire this order off just to see what that looks like. And again, remember, this is not a recommendation, simply an illustrative example. Remember, we want to make sure that we're aware of all of the characteristics of the trade, that this is what we want to do, that we're willing to spend that $1,400 because that's our theoretical maximum loss on this trade. So what we're going to do is I'm going to put this in my long options group, and we're going to go ahead and click on send, and we're going to fire that order off, and we'll see if that fills. Now, and finally here, let's see if we can put together the long call vertical spread. Still with a fairly intermediate to long-term duration. So I'm going to go to the next, so that we're not confusing the two, I'm going to go to the next expiration in. So I'm going to go to the 3rd Jan expiration. That's 37 days to go until expiration, just so that there's a clear delineation between the two. But remember, and there goes our long call. But remember, if I do this, what changes is that Vega is probably going to go down a little bit, theta is going to go up a little bit, and our delta is probably going to stay the same for an equal strike price. But what we're going to do is, if maybe we're not quite as directionally sensitive, but we still see that there's the possibility for some directional movement in this particular case, one way that we could create this trade might be a long call vertical spread that may be a little bit less expensive. So what we're going to do is we're going to do the same thing. We're going to go to the 225 strike, directionally sensitive. We're going to buy the 225 strike, but at the same time, we're going to sell the 235 strike. So we're going to make a $10 wide vertical spread, and for it, we're going to pay about $6.90. So what we need to have happen here in this case to get to theoretical maximum gain, this is about half the cost of the long call option that we just bought, about half that cost, but we don't have the unlimited potential gain. We have about $310 of potential upside gain. So what we're going to do in this particular case is expect that the price of the stock is going to move. And it really only has to go to the what did we say the strike price was here? Let me go back to my trade tab, 235. So the stock's currently sitting at 234.96. It really doesn't have to go very far. In fact, not very far at all. 4 cents to get to that theoretical maximum gain, assuming that the price of the stock, as we get that time decay here in this particular case. So doesn't have to be directionally sensitive in this particular case. If we right click and we send this to the Analyze tab and we look just at that vertical spread, here's what we're looking at for this vertical spread. And if we set our break even slices to break even, right, at that expiration, here's our break even. As long as the price of the stock stays above 231.87 through expiration, then we're in this area here where there is the potential to make some gain on the trade, or theoretical maximum gain on the trade. Where this trade works against us is if the price of the stock goes down. But notice that our theoretical maximum gain here is only $6.90 as opposed to $14.40. So about half the theoretical maximum loss, but we've limited the upside. So that's kind of the choice here. Directionally sensitive, duration sensitive, and benefits from low and rising implied volatility. So as we answer those 3D questions here, right, that really is kind of the circumstance that we use, or that a trader might use, for making a decision about a trade. So let's go ahead and let's place this trade as well. We're going to pop that back up down here, and we're going to make sure that we click on confirm and send, read through the order, make sure that we're aware of that. Now, here's the thing. If this trade, if that short leg were to be called early or assigned early, then that puts us at a theoretical maximum gain scenario here. So that's not a bad thing to have happen necessarily in this particular case. So I'm going to put this in our long verticals and diagonals group so that we can keep track of it. And I'm going to go ahead and click on send and fire that order off. So 3 trades, 1 not directionally sensitive, shorter time frame, and benefits from low and rising implied volatility based on what the market is doing. A long call option here on Apple, taking advantage of directional movement and longer duration and low and rising implied volatility. And now finally, this long call vertical spread, low implied volatility and rising. Time passage doesn't hurt us in this particular case, and it's a little bit directionally sensitive. So that maybe is a process. Ask yourself those 3D questions. And if you want to learn a little bit more about this, by the way, I teach on Thursdays, which is tomorrow because that's Thanksgiving, so you won't see it, but I teach a webcast on long vertical spreads. So if you want to learn about long vertical spreads, you can come over here into the webcast search box and type in long vertical spreads, and you're going to get my playlist for long verticals, and we cover a variety of different topics. So, Chris, if the return on risk in that particular case is not to your particular preference or liking, you can shift it, right? Shift the strike prices to adjust, widen it out, shift the strike price, shift it to being further out of the money, and adjust it to meet that. In this particular case, low potential maximum loss, theoretic relative to the long call, but the stock doesn't have to move very much, right, to get us there. Now, by the way, if you guys have the opportunity to travel over the course of the next couple of months, come and join us in either Orlando coming up next week, Houston coming up the week after that. January, we're going to be in Dallas, Texas. Later in January, we are going to be in San Diego. And then even later in January, we're going to be in Seattle. We've got lots of great live events coming up. All of those are going to be 2-day technical analysis and option strategies workshops. So we would love to have you come and join us for one of those events. By the way, you can follow me on X at Ben Watson CS. You can follow Cameron May on X at Cameron May CS. And again, click on that subscribe button so that you can keep track of what's going on over here on the Trader Talks webcasts. And remember to fill out that feedback survey. Guys, everybody have a great Thanksgiving. And my thanks to Cameron May for helping out here. My thanks to our great production staff for helping to bring this webcast to you as well. Everybody have a great Thanksgiving, and we will see you guys back here again. We are dark tomorrow. Markets closed half day on Friday, so we've got a limited run of webcasts on Friday as well. Full calendar on Monday coming up, and we will see you all then. Take care, everybody. Bye-bye.